Hi, this is James Shug at Westpac with Westpac London's end of day report for Tuesday, April 17th. It's a very positive day on equity markets today for a change. We saw a range of economic data releases. Some of them were positive, some of them less so, particularly related to the US. But the dominating developments today, I think, were the IMF upgrading its global growth forecast. Compared to January, when they had a 3.3% forecast for 2012, they've lifted that to a 3.5% forecast growth rate now. They've lifted their US growth rate forecast. They've lessened the depth of the European recession that they expect this year, and they've tweaked their Japanese, Chinese, and other numbers. In fact, only two countries had downgraded forecasts, and they were Spain, which is now they now expect to decline by 1.8% this year, from 1.6 previously, and a very slight 0.1 downgrade to their Indian forecast at 6.9% now. The previous IMF forecast was done in January, which is probably at the depth of the market's concern and economists' concern about the global growth outlook. It was just after the first LTRO by the ECB, but before the sense had really kicked in that maybe that had really changed things. And so compared to 3 months ago, the IMF feels a bit more confident about the global growth picture. I've got to say, at Westpac, we're on 2.8% for global growth this year, so we're a little bit more concerned, particularly about the European story, and we also think that the IMF's previous forecast, 1.8% for the US this year, is probably more likely to prove to be the more accurate one. Anyway, we can quibble about forecasts. That was one of the good news items today. The other was that Spain had a T-bill auction which went off very well, was oversubscribed. They've got a bond auction on Thursday. The concern was, with bond yields pushing above 6%, that that wouldn't go at all well, and that would emphasise the problems that Spain might have in the future, continuing to finance its debt and deficit positions. But it seems, at least for the shorter paper that was auctioned today, that there is still some demand out there. Maybe it's because markets are convinced that at some point the ECB will step in a bigger way and support the Spanish bond market. But whatever, it was certainly well received by stock markets today. On the data front, US housing starts fell almost 6% in March. There's always volatility in the multiples component, but when you look at the single family picture, there's now 2 consecutive declines there in singles, both in February and March. And on the permit side, single family permits posted their first decline in 6 months, actually. We think there's a bit of a weather factor at play, that the apparent strength in housing around the turn of the year may have been due to milder than usual weather, which meant that more housing activity could take place than would normally be the case during the winter. That comes through as a season adjusted rise, but you then get payback later in the year when the usual increase in activity doesn't take place, because it already has. And that comes through as seasonally adjusted declines, which is what we saw in March. So that was a little bit disappointing. Industrial production for the second month running in the US was flat, 0. The big difference between February and March was that whereas in February there was a decent rise in manufacturing output, and in fact on top of very decent rises in prior months as well, in the March data there was actually a fall in factory output. Autos were up, but pretty much everything else was down. But what prevented an overall decline in industrial production was quite a big pickup in the utility part of production. Now utilities, this is related to the weather story again, utilities have been flat or falling, I think, pretty much every month since a big rise in utility output in July last year, when the summer was particularly hot and everyone was using their air conditioners. This time around, through the winter, they weren't using their heating as much, so utility output was constrained. We're now getting into the post-winter period, and the seasonal factors are now pushing the data around, correcting for that weakness, with gains coming through. So that's further evidence that the weather really has been a significant influence on US data over the last few months. Perhaps making the data look a little bit healthier than it might really have been. there was some Fed speak. Bullard from the St. Louis Fed thinks the economy is going to accelerate to 3% this year, and policy is about right and doesn't need to be changed. Bank of Canada on hold at 1%. They did actually introduce a very slight tightening bias by saying that some modest withdrawal of the present considerable monetary policy stimulus may become appropriate. The timing and degree of any such withdrawal will be weighed carefully against domestic and global developments. So a very slight or modest tightening bias creeping into the Canadian policy makers' minds. One other interesting piece out of Europe was that the German ZEW survey of analysts for April posted a 1-point rise. Now that's, I think, the 5th month in a row that it's risen, but given that between December and March it rose something like 70 points as it sunk into investors that, hey, this ECB LTRO thing actually is doing something, it's actually helping the banks avoid a credit crunch. That really improved investor sentiment. The fact that it only rose 1 point after that 75-point gain over the previous three months suggests that there's no further expectation that things are going to get that much better. Although other measures of investor sentiment, such as the Centix sentiment survey we saw recently, actually fell in April, and I think that might be the next step for ZEW. If the concerns that have legitimately rearisen about Spain and Italy and the lack of response from the ECB, if they continue to bubble over. They certainly haven't today, but they certainly remain the big risk, and indeed remain the big risk to the IMF forecasts. They noted that, well, the key risk they noted, in fact, was the risk of a renewed upsurge of the crisis in Europe, as well as geopolitical uncertainties, they said. UK CPI edged up a tiny bit. It's been falling sharply, but food pushed it up a bit in the March numbers. Won't prevent the Bank of England from engaging in a further round of quantitative easing to be announced, we think, at their May meeting. So that's it in terms of the news today. Markets then. We've got the FTSE in London up 1.8% at the close. The French market up 2.75%. The Germans up 2.7%. And the Spaniards beneficiary, 2.3% for Spain, and Italy's up 3.7% today. And halfway through its session, the Dow in the US is up 1.6%. So the weaker US data didn't really worry the investors too much there. They were focused more on the IMF story and the positive vibe coming out of European markets following that Spanish bond auction. On commodity markets, we're looking at gold up 0.2%, $1,653 an ounce, copper up 0.5%, and oil up 1.6% today at $104.55 a barrel. The Aussie dollar, it's risen 1.041 against the US dollar, benefiting from today's risk-on attitude. We've got the leading index for Australia coming up. We're publishing that in the Sydney session upcoming. The Reserve Bank minutes made it pretty clear there's going to be another rate cut in Australia, provided inflation is well behaved, and we're looking for that to come through in May with a follow-up not too long after that. All right, I'll be back with more tomorrow.